We read not merely to memorize content, but to learn how to think. Welcome to Karochin, where every read becomes a turning point in your growth. Today, we're not talking about some book that tells you which stock to buy tomorrow. We're talking about a guide that teaches you how to be a great investor for life. It comes from Warren Buffett, the man who later became known as the Oracle of Omaha. But the content isn't some reflection written after he became famous. It's a collection of letters he wrote to his partners between the ages of 25 and 35. Why are these letters worth reading over and over again? Let's start with some numbers. In 1956, Buffett started his partnership with just $105,000. By the time he closed it in 1969, the total return had reached 1,403%, while the Dow Jones Index rose only 185% during the same period. What's even more impressive is that during those 13 years, the market went down in 4 of them. In the worst year, it fell by 15.6%. Yet, his partnership didn't lose a single dollar. You might say, well, he's a genius. We can't copy that. But the most valuable thing in these letters isn't genius tricks. It's the simple so-called foolish truths he understood right from the start. For example, when he was 25, he told his partners, "I can't promise how much money we'll make, but I can promise 2 things. First, I'll only buy what's worth the price. Second, my money is tied up with yours." That wasn't just talk. He literally invested all of his and his family's net worth into the partnership. These letters are like a mirror. They reflect the simplest truth about investing. The key to making money isn't guessing right, it's avoiding mistakes. It's not about chasing opportunities, it's about sticking to principles. Take 1962, for example. The market dropped 22%, and many star funds lost over 30%. But Buffett still made a gain of 13.9%. He didn't predict the downturn. Instead, he positioned himself early for merger arbitrage, buying shares of companies that had announced takeovers and betting the deals would go through. That kind of return had little to do with whether the market went up or down. Behind it was his principle. In a bear market, don't expect to make a fortune. Losing less is winning. Here's another detail. He kept saying in his letters, don't focus on short-term returns. In 1959, one of his partners complained that their profits were lower than another fund's that year. Buffett replied, "If you bought a farm, would you sell it just because next year's harvest wasn't great?" Later, that same stock they complained about tripled in just 3 years. Another amazing thing about these letters is that they record Buffett's evolution, from a small capital investor to someone who could control entire companies. In the early days, he focused on unwanted bargains, companies whose stock prices were even lower than their cash on the books. Later, when his capital grew, he started buying large stakes and taking control, like with Dempster Mill Manufacturing. He cut out unproductive operations, shifted assets into higher return securities, and doubled the company's value in just 3 years. This hands-on experience, growing from small to big, is far more practical for ordinary investors than any theory. In the end, these letters don't teach us how to beat the market, but how not to be beaten by it. Next, we'll unpack his toolbox of principles, from how he understood the market, to his core logic for making money, and finally how he picked stocks and avoided traps. You'll realize that the ideas that made him rich are so simple, they hardly sound like secrets, but that's exactly the magic of investing. The simpler the principle, the longer it lasts. To really understand Buffett's investment wisdom, you have to grasp 2 foundations first. The first is the rules he set for himself and his partners, the clear basic principles. The second is how he viewed the temperament of the market, understanding its true nature. These 2 are like the foundation of a building. Everything that came later, his strategies, his methods, grew out of them. In 1956, when Buffett first started his partnership, he sent a few pages to his 7 original partners. They weren't complicated contracts. They were 7 principles he believed everyone had to agree on. They weren't meant as restrictions. They were a filter. If you didn't agree with them, you simply shouldn't join from the start. Principle number 1, no guaranteed returns. Capital safety comes first. He made it clear. I'll never promise how much we'll earn each year, but I'll do everything I can to avoid any permanent loss of capital. For example, one partner wanted to withdraw 0.5% in interest every month. That's about 6% a year. Buffett told him straight, if long-term returns are lower than 6%, that interest you're taking is actually your own capital. Behind this is his core understanding of investing. Returns are given by the market and the companies. No one can promise them. But protecting your principal, that's something you can control. Principle number 2, judge performance by relative results, not by absolute profit or loss. He said, earning 10% in a year isn't impressive unless you know what the market did. If the Dow Jones went up 2% and we made 10, we actually lost. But if the index dropped 10% and we made 5, that's a big win. This mindset breaks the common trap of focusing only on how much money you make. For example, in 1962, the market fell 16.8%, but Buffett's partnership gained 13.9%. That victory in a bear market was far more meaningful than making 30% in a bull run. Principle number 3, performance should be judged over at least 3 years, ideally 5. He used an analogy. You wouldn't decide if a place is a desert just by looking at one season's rainfall. The short-term market is like a crazy person. 1 year's return could just be luck. In 1968, for instance, he made 58.8%, but even he said that was an extreme case, not real skill. Principle number 4, don't predict the market, and don't rely on predictions. He made it clear, if you think I can forecast market ups and downs, you'd better not join. He repeated this again and again in his letters. Before the 1966 market crash, one partner asked if they should sell everything. Buffett replied with a sharp line, if you didn't know in February that May would fall, you won't know in May what's coming next. Principle number 5, invest based on value, not popularity. He promised his partners, we buy stocks based on what the company is worth, not on the news, not on trends, not on what others are buying. For example, when he bought Sanborn Map Company, the market thought map making was outdated. But Buffett calculated that the company's securities portfolio was worth more than its entire market value. That's the value principle in action. Principle number 6, always seek a margin of safety. Diversify, but don't over-diversify. A margin of safety means buying below true value. If a company's worth 100, he'd only buy it under 60. He would hold several positions, but never a pile of mediocre stocks. As he said, owning more of the best stock is better than owning 10 average ones. Principle number 7, alignment of interests. My money is invested right alongside yours. This was his toughest and most honest rule. He said, all of my family's net worth is in this partnership. It wasn't for show. It was to eliminate the temptation to take risks with other people's money. Even later, when he ran Berkshire Hathaway, he still kept his own money tied to the company. The core of these 7 principles is simple. Turn vague investing into a clear set of rules. Lay everything out up front. Manage expectations in advance, so no one has to guess, argue, or second-guess later. Understanding the principles isn't enough. You also need to see what the market really is. Buffett's teacher, Benjamin Graham, explained it perfectly with a metaphor. Imagine you have a neighbor called Mr. Market. Every morning, he knocks on your door and offers to buy or sell your stocks at a price. Sometimes he's cheerful and offers a ridiculous price. Say $100 for a stock worth $50. Other times he's depressed and only offers $20 for that same stock. The key is, you don't have to answer the door. You can sell when he's offering high, buy when he's offering low, or simply ignore him. But most people do the opposite. When the neighbor panics, they panic too. When he goes crazy, they go crazy. Graham had another famous quote. In the short run, the market is a voting machine. Prices are decided by emotions, rumors, and trends. But in the long run, it's a weighing machine. It reflects the company's true value. For example, in 1964, American Express was hit by the salad oil scandal. Its stock price crashed, and everyone was selling like crazy. But Buffett went to the supermarket and noticed people were still using their Amex cards. The foundation of the business hadn't changed. So he bought a big position, and later the stock went up fivefold. That's the weighing machine, eventually correcting the mistakes of the voting machine. Buffett wrote in his letters that if the market shut down every day, it would actually be good for long-term investors. You wouldn't be distracted by short-term price quotes. He even hoped Mr. Market would go crazy once in a while. The more depressed he gets, the better chance we have to buy bargains. In 1957, when the market plunged, Buffett was happy. Stocks that were too expensive before finally dropped to a price he could buy. That year, he earned 9.3%, while the Dow fell 8.4%. The core of all this is to help you build your own investing compass. First, use the basic principles to frame your behavior. Don't be greedy. Don't speculate. Don't follow the crowd. Know what you should do and what you must never do. Second, understand the market's true nature. Volatility is normal, and your neighbor's price quote is not the company's real value. Once you understand that, the next question becomes simple. If the market eventually reflects value, how do we let time make money for us? That's where the most counterintuitive yet powerful force in investing comes in: compound interest, and the simplest shortcut for ordinary people: index investing. Once you understand the nature of the market, the next step is mastering the core logic of making money work for you automatically. In his letters, Buffett kept emphasizing two words: compound interest and index. The first is the magic of time, and the second is the shortcut for ordinary people. If you truly grasp these two formulas, you've unlocked the foundation of how wealth grows. Buffett said that compound interest is like rolling a snowball down a hill. At first, the snowball is tiny, but as it keeps rolling, it gathers more and more snow until it becomes a giant mass. It sounds simple, but to really make that snowball roll, you've got to get past two hurdles: understanding its power and enduring its slowness. The first hurdle is the math trap of compounding. A small difference can lead to a huge gap in results. He once made a chart, starting with $100,000 after 10, 20, and 30 years at different annual returns. At 10% per year, $260,000 after 10 years, $670,000 after 20, $174 million after 30. At 15% per year, $400,000 after 10, $164 million after 20, $662 million after 30. At 20% per year, $620,000 after 10, $383 million after 20, $24.98 million after 30. Just a 5% difference in return, and after 30 years, the gap is 14 times bigger. That's why Buffett obsessed over earning just a few extra percentage points each year. He knew that time would magnify small differences into massive outcomes. The second hurdle is the time leverage of compounding. The earlier you start, the more free money you get. Buffett began rolling his snowball at 25. He once calculated if, in 1956, the year he started his partnership, he had spent $10 on a haircut instead of investing it, at a 22% annual return, by 2014 that haircut would have cost him $1 million. That's one expensive haircut. Most people think, I'll start investing when I have more money. But the brutal truth of compounding is this: if you start with $100,000 at 25 versus $200,000 at 35, even at the same rate of return, the earlier investor ends up with over twice as much by age 60. So why do so many people understand compounding but still fail to profit from it? Because they can't resist stopping the snowball. They switch investments when short-term returns look weak, or they cash out too soon to spend the gains. Buffett criticized this in his letters. It's like planting an apple tree, then chopping it down just as it starts bearing fruit. How can you expect a full harvest? During his 13 years running the partnership, he almost never withdrew funds midway. He even reinvested his own profits, which is how his snowball kept growing. When Buffett was young, he realized a painful truth. Most fund managers, after all their hard work, still underperformed simple index investing. Not because they were dumb, but because active management comes with three unavoidable traps. The first trap is group decision-making. It kills outperformance. He complained that when a group decides what to buy, they almost always choose the safest option, not the most profitable one. Everyone's afraid to be different, So they stick to the same blue-chip stocks as everyone else and miss the real bargains. The numbers prove it. From 1957 to 1969, the Dow Jones returned 7.8% annually, while most mutual funds earned only around 6%. Groupthink literally cost them returns. The second trap is fees and turnover quietly eating away your gains. Active funds charge management fees, usually 1% to 2%, and trade frequently, paying commissions each time. It doesn't seem like much, but over decades it's devastating. Buffett calculated that a fund earning 10% annually but charging 2% in fees will end up with half the wealth of a low-cost index fund charging 0.1%. Even worse, many managers trade excessively just to look busy, turning their portfolios over 100% a year, selling stocks before they've even had time to grow. That kills compounding. The third trap is the curse of scale. Too much money, too few opportunities. The better a fund performs, the more investors pour in. But the market only has so many bargains. A $10 million fund can buy a $500,000 small-cap stock. That's 5% of its portfolio. But if it grows to $1 billion, that same stock becomes meaningless. So they're forced to buy large-cap stocks everyone already owns, and there goes the edge. Buffett faced this himself, by 1966 managing $43 million. He had to stop taking new investors because opportunities were drying up. Since active management is so hard, why not just follow the index? Buffett said in his letters, "If you don't want to spend time researching stocks, just buy an S&P 500 index fund. In the long run, it will beat 80% of professionals." He even left his wife instructions in his will: put 90% of the money in an S&P 500 index fund and 10% in short-term government bonds. His reason? Simple. That setup tracks U.S. economic growth without worrying about fees or managers' competence. Once you understand compounding, you realize patience matters more than brilliance. A steady 15% beats chasing 100% in a year. And once you understand index thinking, you stop believing promises to beat the market. For most people, not making mistakes, like buying the index, already puts you ahead of the majority. But then comes the question, if index investing works so well, why did Buffett still pick individual stocks? Because he could find opportunities that beat the index, undervalued companies, and businesses he could control. That leads us to the next chapter: how to build on compounding and index investing with specific strategies that take it to the next level. If compounding and index investing are the engine of investing, then how exactly do you press the gas pedal and steer the wheel? In his letters, Buffett breaks this down into two key questions. What standards should you use to select investments? And what strategies should you use to actually execute? Put together, these two form a repeatable decision-making system. 1. Start with clear standards. 3 filters to keep you safe. Buffett said you don't need a complex model to invest. What you need is a set of filters that you can use again and again. His own filters come down to just 3. The first filter: figure out what the business is truly worth. Investing is about buying companies, not stock symbols. Buffett looks at a business by calculating its intrinsic value. Not by checking the stock price, but by estimating how much the company can earn in the future, and then discounting that back to today's value. For example, when he bought Federal Trust Company, he figured it out clearly. This bank earned $10 per share every year, had reliable management, and its liquidation value was at least $125 per share. Yet the stock was trading at just $50. That's like paying $50 for something worth $100. The value is obvious. In his letters, he kept saying, "Don't trust the market's price. Do your own math, and if you can't figure it out, skip it." That's his circle of competence principle. Only play in fields you truly understand. The second filter: always keep a margin of safety. Give yourself room to be wrong. Buffett likes to use a metaphor. Buying stocks is like driving across a bridge. If the bridge can hold 10 tons, you don't drive a 10-ton truck over it. You drive a 5-ton one to stay safe. When he bought Sanborn Map Company, the value of its securities portfolio was already higher than its stock price. It was like buying the mapping business and getting the securities for free. Even if the map business lost money, the securities would cover the downside. He made nearly triple his money in 3 years on that deal. This rule helped him avoid the biggest traps. Even if he misjudged a company, as long as he bought it cheap enough, he could still avoid big losses, or even make a gain. The third filter: it has to fit your personality. Otherwise, you won't have the patience to hold on. Buffett admits, "I don't touch tech stocks, not because they're bad, but because I can't understand how fast they change." In his system, sleeping well matters more than chasing higher returns. Take his early investment in Dempster Mill Manufacturing. It was an old factory, but he could clearly see issues like overstock and lazy management. He also had the patience to wait 3 years while fixing them. That's what it means to find investments that fit your temperament. 2. Now, let's talk strategy. 3 paths, one will suit you. Once you've set your standards, how do you actually pick investments? In his letters, Buffett summarized 3 strategies, from bargain hunting to taking control, covering investors of all sizes and temperaments. Strategy 1. The undervaluation play. Perfect for patient investors who love finding bargains. The core idea is to find companies the market has temporarily mispriced. Stocks trading below liquidation value or with more cash than market cap. When he bought Federal Trust, the market hated it for not paying dividends, and the price dropped to $50. But he had calculated it was worth $125, so he quietly kept buying. Eventually, when the market corrected itself, he made a 60% profit. The key: don't expect quick results. These plays usually take 1 to 3 years. You need to endure the loneliness of being misunderstood. Strategy 2. The merger arbitrage play. Best for people who like to crunch numbers and prefer certainty. This is about making money from deals that are likely to close. When a company announces a merger or acquisition, its stock usually trades a little below the deal price. If you bet the deal will go through, you can profit from that small spread. In the Texas National Petroleum case, Buffett calculated everything clearly. The offer price was set, and the main risk was a tax ruling not passing. But after digging deeper, he found the other party was a charity willing to compromise. So he went in big. In the end, he earned about a 20% annual return. The key here: only take bets where the odds are clearly in your favor. If the risk of failure is over 30%, no matter how good the potential profit looks, skip it. Strategy 3. The control strategy. This one's for investors with large capital and hands-on skills. Once his fund got big enough, Buffett stopped just buying stocks. He started buying control. When he took over Sanborn Map, he found management was sitting on valuable assets but doing nothing. So he became a major shareholder and forced the company to liquidate its securities portfolio. Shareholder returns instantly doubled. The key here: don't touch companies you can't fix. He only bought businesses with good assets but lazy management, like Dempster Mill, where he turned things around by replacing managers and clearing inventory. These standards and strategies sound simple, but Buffett repeatedly warned in his letters. Winning on paper is easy. Winning in execution is hard. Undervaluation requires patience through downturns. Arbitrage requires calm during market noise. Control requires discipline, not to meddle too much. Next, we'll dive into the common pitfalls people fall into when trying to apply these ideas. Because in investing, the most valuable thing isn't knowing what to do. It's being able to do it without making mistakes. If the earlier principles and strategies are the map, then this part is about the traps you'll face on the road. Buffett often said in his letters, "In investing, emotional stability beats high IQ, and knowing theory matters less than knowing when to hit the brakes." Half of these traps come from human nature, and the other half from small details people ignore. Avoiding them is far more important than finding the next hot stock. First, let's talk about human nature. What you think is rationality might just be your emotions in disguise. The first trap: chasing highs and panicking on dips, letting Mr. Market pull you by the nose. In 1962, during a sharp market drop, Buffett wrote, "The scariest thing isn't the decline itself, it's the panic of thinking, everyone's selling, so I have to sell too." That year, The Dow Jones fell 16.8%. Many investors panicked and sold at a loss, while Buffett, sticking to his rule of losing less in a bear market is winning, actually made 13.9%. He once gave an example. A partner jumped into the market in 1961's bull run because his neighbor said a stock could double. When the bear market hit in 1962, he lost 40%. That's the classic Mr. Market story. You follow when he's euphoric and run when he's depressed. The fix is simple. Treat market prices as references, not commands. When Buffett bought Federal Trust, no matter how the price jumped short-term, he focused only on the fact that he was paying $50 for something worth $125. That patience paid off. The second trap, overconfidence, mistaking luck for skill. In 1968, Buffett's partnership gained 58.8%, a record year. But he poured cold water on the celebration, saying much of that profit came from luck. That year, speculation was rampant, and even his holdings were bid up beyond reason. He knew the truth. Money made in easy times often comes from the market, not from you. Most people make the same mistake. They see one good year, think they're geniuses, then start taking bigger risks in things they don't understand. Buffett said he'd seen it countless times. Every year, some newcomer gets lucky and makes a fortune, but very few survive 5 years. The third trap, trying to win back losses too fast. In 1966, one of Buffett's partners pushed him to go more aggressive after a disappointing year. Buffett replied, "Investing is like golf. If you mess up one round, the next round is when you need to steady your rhythm, not swing harder trying to make up for it." He even did the math. If you lose 50% one year, you need to make 100% the next just to break even. Trying to gamble your way back usually makes things worse. His turnaround of Dempster Mill took 3 years. The stock went up and down many times, but by staying calm and patient, he turned the results into a snowball of returns. Now, let's talk about the devil in the details. Because small things can destroy your compounding. First detail, fees and taxes quietly eat into your returns. In his 1963 letter, Buffett did the math. If you own a stock that compounds 15% a year, but trade it once a year, after paying 1% in fees and 20% in capital gains tax, your 30-year return would be 40% less than if you had simply held it. His own rule was simple. If you don't need to trade, don't. Take his American Express investment. He held it for more than a decade. No matter how the market swung, he just sat tight and let compounding work, turning that into dozens of times his original investment. For regular investors, staying still is often the best way to save money. Second detail, diversification is not the same as random buying. People say diversification reduces risk, but Buffett pushed back hard against that idea. Owning 50 stocks you don't understand is worse than owning 5 you truly know inside out. The first is just spreading bets. The second is real risk management. Even at its largest, his partnership held only about 10 stocks, and 3 of them made up 70% of the portfolio. The key isn't how many stocks you hold, but how uncorrelated they are. For instance, holding both a bank stock and a consumer stock. If one drops, the other might hold up. Third detail, ignoring liquidity. When you need cash urgently, you're forced to sell at a loss. In 1969, when Buffett dissolved his partnership, he warned investors, never put short-term money into the market, no matter how bullish you feel. He'd seen too many people forced to sell promising stocks just because they needed cash for tuition or emergencies, cutting their compounding short. The simple fix, divide your money into 3 buckets: cash for short-term needs, index funds for medium-term money, and individual stocks for long-term plays. And never mix them up. If you think about it, whether it's chasing prices out of emotion or losing returns to hidden costs, it all comes down to one core issue: not having a principle you can truly live by. Buffett said, "Investing doesn't require a high IQ. It requires finding a principle that fits you and sticking to it, no matter what." Next, we'll talk about how to turn those principles into habits so ingrained that you can not only see clearly, but also endure patiently. If the principles and strategies we talked about earlier are like a theoretical map, Then this part is about something more practical: how ordinary people can actually turn those ideas into real returns. In Buffett's letters, there are 3 pieces of advice that sound so simple, they almost go against common sense. Each one carries the lessons he learned from falling and getting back up. The first one is this: don't copy Buffett's tricks. Learn how Buffett found his own. A lot of people read his letters hoping to dig out which stock could double. But if you look closely, Buffett never gave stock tips. He just kept saying one thing: find a principle that fits your own personality, then stick to it stubbornly. When he was 25 and just starting out, he only had $100,000. So he focused on small, overlooked companies, like Dempster Mill Manufacturing, worth just $1.6 million at the time. He bought it cheap, restructured the business, and doubled its value. Later, when his capital grew into the millions, he shifted to a controlling investor approach, buying large stakes and personally stepping in to improve the companies. The takeaway for ordinary people is simple: don't copy someone else's playbook. First, figure out what you can handle. If watching the market every day keeps you up at night, then don't try to trade short-term. Just buy an index fund and let it sit. If you might need the money within 3 years, don't invest in something that takes 5 years to pay off, no matter how good it looks. If you don't understand financial statements, don't chase tech stocks because everyone else is buying them. Buy businesses you actually understand, the supermarket you shop at, or the appliance brand you've trusted for a decade. Buffett said, "Investing isn't about being the smartest. It's about being yourself." Finding the principle that lets you sleep at night is better than any secret formula. The second piece of advice: what ordinary investors lack isn't vision, it's the patience to let the math work. We often think people who make big money must have some kind of sixth sense, but Buffett's letters reveal a harsher truth. His success came not from always being right, but from losing less when he was wrong and keeping up when he was right. Between 1957 and 1969, the Dow fell in 4 of those 13 years, 16.8% in 1962 and 15.6% in 1966. But Buffett still compounded steadily, losing little in bear markets and keeping pace in bull ones. For instance, in the big drop of 1962, while others were bleeding, his partnership still made a 13.9% gain, thanks to a mix of control investments and merger arbitrage. What most people lack isn't the eye for a super stock. It's the patience to wait long enough. If you bought a stock and it hasn't moved in 3 months, don't panic. Buffett's average holding period was 8 years. If you've been investing in an index fund for 2 years and haven't seen profits yet, just keep going. Over 30 years, the S&P 500 had 10 losing years. But investors who kept buying through the dips and didn't sell during rallies ended up compounding huge gains. Remember this number: even if you beat the market by just 5% per year, after 30 years your total return will be 4 times higher than the average. That's the magic of patience. The third point: you don't need to study investing full-time. You need embedded habits. Many people say, "I don't have time to research companies, so I can't be a good investor." But Buffett said, investing doesn't require full-time effort. It just needs to become part of your daily routine. His own habit was simple: spend 1 hour a day reading reports or news, then move on with his life. He said, "I've seen too many people stare at the market for 8 hours a day when they'd be better off spending 1 hour understanding their risk tolerance." Ordinary people can do the same. Use small pockets of time to collect clues. When the drink you buy every week gets more expensive, maybe that company is raising prices and improving margins. If the supermarket near your home always has long lines, maybe it's running more efficiently than its competitors. Use simple, foolproof tools to make things easier. For example, set up an automatic investment plan for an index fund. Let it pull money from your paycheck every month so you don't have to think about timing. Create rules so simple you can't possibly quit, like only buying companies with a PE ratio under 20 and 5 straight years of profits. Or don't buy more when prices fall, don't chase when prices rise. Just stick to your plan. These habits might look small, but as Buffett said, investing isn't a race of speed. It's a marathon of persistence. In the end, the core of all this advice isn't about how to make money. It's about how to avoid losing to the market. But having the right posture isn't enough. You've got to carve these principles into your bones, and that takes some counterintuitive training. In the next part, we'll talk about how to turn these principles into reflexes, so that when the market surges or crashes, you can still hold your ground and move at your own rhythm. All these years reading Buffett's letters, I kept asking myself one question. Why is it that some people can use the same principles to build a snowball, while others just spin their wheels in place? Eventually, I realized, in investing, the most valuable thing isn't knowing what to do, it's finding your own rhythm. Before Buffett dissolved his partnership, he said something that I've kept in my notebook ever since. Investing doesn't require a high IQ. It requires emotional control. And he was the best example of that himself. When he was young, he built his fortune picking up cigar butts, cheap, discarded stocks with one last puff of value. As his capital grew, he shifted to controlling stakes, buying and improving entire companies. But he never forced himself to chase new trends he didn't understand. In 1969, when he shut down his partnership, it wasn't because he'd made enough money. It was because he saw fewer opportunities that met his own principles. That kind of clarity, the ability to stop, is far more valuable than any get-rich-quick secret. Most people think the key to investing is learning how to pick winning stocks, but these letters reveal a more grounded truth. The ultimate answer in investing is to find principles that fit your personality, and then stick to them relentlessly. You can focus on value like Buffett, hunt for growth like Peter Lynch, or stay passive like an index fund. What matters isn't being like someone else. It's making peace with yourself. I've seen too many people copy Buffett by buying cigar butt stocks, only to give up halfway when prices went nowhere for 6 months. Or imitate Peter Lynch, researching companies deeply, but selling the moment someone said something negative. In the end, the ones who truly succeed at investing aren't those who never make mistakes. They're the ones who find a way to make fewer of them. If you ask me what I most want to do after reading all these letters, my answer is simple. Pick a weekend, grab a notebook, and write down 3 red lines you'll never cross. For example, never buy a stock with a PE above 30, and never let a single position exceed 20% of your portfolio. Then tape that list to your desk. Because the most powerful thing in investing isn't how much you know, it's surviving long enough to turn knowledge into wealth. That, I think, is Buffett's final gift to us through these letters. Investing is like a marathon. The winners aren't the ones who run the fastest, but the ones who take fewer wrong turns and stay on course. And now, you're already holding the most precious map of all. Congratulations. You've just finished another book.